The global economy is shifting, tariffs are rising, a trade war seems to be looming, and while everyone's focusing on manufacturing, SaaS founders are overlooking and ignoring the storm headed their way. In this video, I'll talk about everything you need to know to understand the current global macroeconomic situation, and more importantly, what you need to do about it in order to not just survive, but to thrive. Let's go ahead and get started. So I'm going to break up this video into 5 parts. First, we're going to talk about some key terms and their definitions. Second, we're going to talk about some key economic concepts related to international trade, tariffs, and how that trickles through the economy. Third, we're going to talk about the impact on the US economy from all these different changes. Fourth, we're going to talk about how this impacts SaaS businesses specifically in terms of the forces at work. And fifth, I'm going to talk about what do you do about all of this? What do you do right now? And what do you have to prepare to do in case certain situations evolve in certain directions? And how do you be prepared for that? So before I get started, I want to share a little bit about my background so you understand the perspective I'm coming to this particular issue with. My formal training academically is from Stanford University in quantitative economics. I started off my career in management consulting for McKinsey, which is a consulting firm serving the Fortune 500 and Global 500 CEOs. I've been working in SaaS the last 25 years principally as an advisor, occasional board member, and occasionally as an investor as well. And then once in a blue moon, I get on national television as an expert commentator talking about how different macroeconomic issues impact small businesses. The last time I did that was back in 2009 with the Great Recession. Lots of macro changes. This situation equally big and significant, but very different in specific. So let's go ahead and dive in. First of all, let's talk about terms. Number one, what is a tariff? So a tariff is an importation tax. When a manufacturer typically imports something and it crosses a border, goes through customs, a tax is added to that, and they aren't able to receive the goods until they pay that tariff or tax. Okay? Now, that manufacturer can then, if they choose to, absorb that tax themselves, or if the tariff is very high, oftentimes they will pass along a part or all of the tariff onto customers in the form of higher prices. So tariffs have a tendency to make prices go higher because of that additional cost the manufacturer has to bear. Next, let's talk about a trade deficit. A trade deficit can be thought of in 2 different ways. The first way to view a trade deficit is to look at the ratio of a country's imports versus exports. If a country imports more than it exports, like the United States does, then we have what's called a trade gap or trade deficit, right? If we are exporting more than we're importing, we have what's called a trade surplus, right? So that's sort of one way to look at it. And for the United States economy in particular, we have been running a trade deficit for a long time because we import more goods than we export. I'll talk more about the significance of this in a little bit. The second way to think about a trade deficit is to look at how much money we spend versus how much money we earn. When we spend what we earn, and it's a perfect match, which means we spend within our means, there is no overall trade deficit relative to the rest of the world. There might be differences in that import-export ratio with specific countries like China, but when we spend within our means, everything that we export, we make extra money, then we import for other countries and it sort of washes out. Okay? So you cannot have an overall trade deficit when you are spending within your means. A trade deficit is only possible when we spend more money than we make. Okay? So here's a simple layperson example of a trade deficit. Let's say I make money and I've spent all the money that I have and there's no money left. Okay? But I want to go to Walmart to go buy something and some goods. And I happen to have a credit card. I can go to Walmart and I can buy, I don't know, a $200 video gaming device, whatever it might be, and I charge it to the credit card. I've technically started a trade deficit of sorts with Walmart, right? Now, if I didn't have that credit card and I could only buy things with cash, I've already run out of cash. I've already spent it all, right? And it is impossible for me to have a trade deficit with Walmart because there's no way to borrow money to buy things, right? So the key factor here, which gets lost a lot in the news, is you cannot have a trade deficit if we spend within our means, right? And as a country in the United States, we have not for a very, very long time. This will be significant in a little bit. So what is a trade war? A trade war occurs when the policies of one country negatively impacts another country and that country sees it as a threat. And in response, they retaliate to defend themselves by enacting their own trade policies that negatively harm the country that they see as the aggressor. So here in the United States, the US federal government perceives China as enacting negative harm onto the US economy. They've imposed these very aggressive tariffs against goods coming from China. Now, from China's perspective, they've just been doing business for many, many years, and out of the blue, the US federal government enacts negative pain and harm that's negatively going to damage the Chinese economy. So they're like, whoa, 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 like we don't want that. So we need to get them to stop. And so we're going to defend ourselves by enacting trade policies that negatively harm the US economy, right? So what's happened is tariffs went up here in the United States on goods from China. China didn't like it. They immediately canceled billions of dollars worth of orders from Boeing, a company here in Seattle where I live. So Boeing is likely going to be severely negatively impacted. And we're pretty upset about that right here in Seattle in the United States. So we raise our tariffs. China goes, whoa, that sucks even more. So we're going to not buy $1 billion worth of beef and soybeans from the United States farmers. We're going to buy them from Australia instead. So the US soybean industry, the beef industry gets negatively impacted. They go into recession. That's not good. The US will respond and escalate. Basically, both sides escalate until somebody blinks and decides this is maybe a bad idea. Okay? So that's kind of the direction what happens in a trade war. It's escalation upon escalation upon escalation. And it's like this old game of chicken, which is a game here in the United States of two cars driving at each other to see which driver is going to swerve to avoid the collision, right? And the problem with a trade war is small businesses and startups are the casualties of a trade war, right? One industry gets decimated, then another in the other country, back and forth, and you sort of trade industries and countries that get decimated until everyone says this is maybe a bad idea and maybe we should stop. So that's what happens in a trade war. And one of the dangers of a trade war is you can't control it, right? You don't know what's going to happen because there's another party involved and it's hard to predict what they're going to do. It's a bit of a guess. There's uncertainty and there's risk. So one of the narratives you see in the popular media is that a trade war seems as argued as necessary in order to reduce the trade deficit to get more jobs here in the United States, right? So one of the narratives that's being conveyed in the popular media is that a trade deficit is bad. It is caused by the bad actions of another country, and therefore we need to engage in a trade war to prompt the other country from stopping doing things that negatively harm our economy, right? We need to defend ourselves. And on the surface, that's actually a pretty reasonable argument. Like, why wouldn't we defend ourselves, right? That makes logical sense. However, a trade deficit can be solved without the cooperation of any other country. So the easiest way to resolve a trade deficit is very simple. It requires no action from any other country. To get rid of an overall trade deficit with the rest of the world, all we have to do is to live and spend within our means. So the amount of money the government raises in taxes, it should spend that money and no more. If we do that, if individual consumers and businesses only spend the money that they earn and they're not going into debt and greater levels of debt, the trade deficit disappears. There might be trade imbalances with a particular country, but that will be offset by trade surpluses with another country. So maybe because China's labor is so much less expensive, that we import more goods from them than the other way, but we also sell to Germany, we sell to France, we sell to Japan, and perhaps our exports to those countries might be offsetting those imports. But again, the key is when we spend within our means, the overall net trade deficit completely disappears. Okay? So a trade war is not necessary to eliminate an overall trade deficit. One might argue, and this is controversial, a trade war might be necessary to resolve a trade imbalance with one particular country, right? And that is a controversial statement, and that can be debated. Okay. Now, what does all this mean for the U.S. economy, right? One word describes what the impact of all this will be for the U.S. economy. And that one word is uncertainty. Uncertainty. Nobody knows what's going to happen. And that is a big problem for Fortune 500 companies and an even bigger problem for small businesses and startups. Let me explain why. When there is uncertainty in the economy, people tend to stop spending, right? If your cost of goods to sell something that you import might skyrocket, right? Then you start getting conservative. Well, I don't know what the right decision is because I don't know what's going to happen. So in those scenarios, and you saw that in 2009 after the Great Recession, you saw that in 2020 with COVID, people tend to freeze. They freeze hiring, they freeze large purchases, they freeze spending on large projects. They just pause to wait it out to see what's going to happen. Okay? That suppresses demand. That's not good. It has the risk of causing a recession. The second factor is when there are tariffs, costs go up. At some point, those costs have to be passed along to customers, both consumers and business-to-business buyers. When prices go up, that has a couple of impacts. One, it causes inflation, right? And second, it has the risk of reducing demand and causing a recession. So if your living costs go up significantly, if the cost of groceries, the cost of gas, the cost of everything goes up 10, 20, 30%, then that's tough on the budget. And that's tough on your wallet. So you'll spend less. At the same time, if your costs are going up for your employees, they need to pay their bills. So they're going to demand a higher salary just to basically eat and have a meal on the table, right? So that puts inflationary pressure on wages, which then raises costs even further because now labor costs more here in the United States, right? So we have all these potential impacts. You have the risk of inflation, prices going up. We have the risk of a recession, demand going down. And when both of those things occur at the same time, it's known as stagflation, right? Where growth is stagnating, we're not growing, we're shrinking, and there's inflation in terms of prices. Now, in terms of a macroeconomy, the single worst scenario you can ever have in a macroeconomy is stagflation, right? You have shrinking demand and escalating prices. It is the worst of all worlds, and it is a disastrous scenario that we absolutely, absolutely want to avoid. Okay? Now, the risk of a recession, the risk of inflation, the risk of stagflation is currently not zero. And that risk is increasing with all these various moves related to tariffs and trade policy. All of that uncertainty, all of that risk is why there's all this volatility in the stock markets, at least at the time of this recording. Okay? It also causes uncertainty and pauses and hesitation in corporate spending, as well as the potential for that in consumer spending. If you are at risk of getting laid off and you're worried, you might just pull back on your spending just in case. Right? Those are the pressures that are at work and how this impacts the overall US economy. All right, part 4. Let's talk about how all of this economic chaos, for lack of a better word, impacts your SaaS business or your startup business. Okay. So again, I think the big risks are that your customers, they're nervous. They don't know what to do with all this uncertainty, and they're in your sales pipeline and they just sort of sit there. They don't close, they don't buy, they don't sign the contract, right? And it's not because they don't like your products. It's not because they don't think your product is better than a competitor. It's that there's so much uncertainty. They don't want to make a mistake. They don't want to sign a large financial contract with a financial commitment that obligates them to pay you when they're not sure about their own revenues, right? And the stability and predictability of those. So that is a very, very significant risk that we have to be very, very mindful of. The second is inflationary pressures. So the cost of your goods sold, if the price of computer chips goes up, the cost of Amazon Web Services, your hosting, your cloud bill will go up, right? That increases and negatively impacts your margins. If the cost of eggs goes up, the cost of soybeans, the cost of gasoline, the cost of goods that your employees buy goes up, they're going to have a harder time paying their bills and making ends meet. So there's upward pressure on wages. And so everyone in your company might come back asking for a raise, right? Which will negatively impact your margins. Now, so those are some examples of the pressures that might be occurring and that we're at risk of receiving if you run a SaaS business today. All right, number 5, what do you do about all this uncertainty in the economy right now? Okay, so there are 2 categories of things you should do. One are things you do right now, and the second are things that you need to be ready to do if this situation evolves or devolves and gets a lot worse. Okay. So the key theme for things you want to do right now is improve your company's ability to be resilient against these macroeconomic shocks, as economists typically call them. So this means this has a couple of implications for you. So first of all, as a offset against inflation, you want to go review your contracts with customers to look at whether you have the ability to raise prices by an amount that you deem necessary, and is that legal in your legal agreements, right? You want the option to raise prices perhaps with a 90-day notice, so that if the economy gets very inflationary, you have the ability to raise prices and match those inflationary pressures on your own costs. So if you have to pay everyone 10% more in terms of your labor, and your AWS bill goes up by 10%, your Azure bill goes up by 10%, you want to be able to pass along some of those increases in costs onto your customers. So go review your legal contracts, your customer contracts, and make sure you are allowed to raise prices and you have some mechanism to do so. If you do not revise those contracts, put all new customers on the new contract, and as old customers come up for renewal, get them on a contract that allows you to raise prices at your discretion, perhaps with some advance notice. Okay? So that's one example of something you can do right now on the revenue side. Another thing you can do on the cost side of the business is get rid of inefficiencies, right? You don't want to have a sloppily run business ever, but especially when the economy is very, very uncertain, you do not want bloat, excess, deadweight, underperformers. So a couple of things you can do. Number one, just get rid of the bottom performers. Your worst performers, the ones you probably should have fired and got rid of for performance reasons maybe a year or two ago, but you never got around to it because you were busy. Do that now. Okay. Also, improve your business processes. Like I see a lot of businesses, I work with a lot of businesses, maybe 5 million to maybe 40, 50 million a year in sales. And a lot of them, the business processes are very sloppy. There's these extra steps that's really inefficient. There's a lot of rework. And all that means is more labor costs needed. Okay. When you have more work and it's inefficiently managed, then your costs go up. Okay. So this is a great time to automate work, right? Get rid of some of those costs. Get rid of rework, get rid of inefficiencies, design workflows that are more smooth so that work flows through very, very efficiently through your operations. Okay? Those are some things you can do on the cost side to get your costs down where you're only paying for things that add value to customers. All right, that's what you can do on the profit and loss side of the business. What you can also do on your balance sheet is strengthen your balance sheet, specifically have more cash. When you have a lot of cash in the bank, it's impossible to go out of business if you have enough cash in the bank, right? Cash is a way of buffering against sudden and dramatic changes in the world, in the economy, and in our own trade and macroeconomic policies, right? Start accumulating cash by being more efficient on the P&L, right? Getting rid of excess costs, being really lean, being really efficient. Build up strength on your balance sheet in the form of excess cash reserves. In terms of customer strategy and go-to-market strategy, one of the things you ought to be doing is looking at where your best customers are coming from, who is your ideal customer profile, which customer segments are more attractive, more economically profitable, more capital efficient than other customer segments, which sales and distribution channels are more capital efficient, meaning you can get a customer and you can acquire a customer and get a much higher return compared to your other distribution channels, right? Your LTV to CAC ratio is very, very attractive as an example. You want to look at your lead generation channels and do the same thing, right? So you want to bias your spending, bias your headcount towards those segments of the market, to those distribution channels and lead generation sources that provide a much higher return on investment or a much higher lifetime value of a customer relative to their customer acquisition cost. That gets you more bang for the buck in terms of your budget dollars. And it's very important to do that proactively right now. Finally, the second category of things you can do is to be prepared for more extreme scenarios should they evolve, right? So these are things you want to be ready for, but you don't want to do right now. For example, if inflation occurs and spirals out of control, you want to have a plan to be able to raise prices on your customers so that you can maintain your margins, okay? I really hope that does not happen, but in case, you need to be ready to think about how you would do that. How would you roll it out? Can you change the prices in your billing system? Are you legally allowed to in your contracts? All that has to be ready on standby in case of that particular more extreme scenario. The second scenario you have to be prepared for is a recession, where there is a dramatic drop in demand and customers just aren't buying, or your existing customers are churning at a higher rate because they're struggling because of these macroeconomic conditions. So in that scenario, you are at risk of having to go out of business if you don't cut costs. So you need some contingency plan, if you would, on how would you cut costs 10, 20, 30, 40% if you had to in a very disastrous sort of scenario. How would you do it? Would you cut out of R&D? Would you cut out of sales and marketing? Would you cut out of overhead, right? Now, you don't want to do that right now because you don't want to negatively harm the business. But if the business shrinks 10, 20, 30% overnight, you may have no choice, right? So again, earlier we're talking about trimming the fat off of your expenses, get lean and mean. This is more like amputating, right? Like, do we want to get rid of the left leg or the right leg? Which one's more important for us, right? Again, hope it never happens, but you be mindful, prepared for that possibility, and know in advance what the skeleton plan of how you would handle that scenario if it were to come to be. So those are the 5 key things to understanding what's going on in the macroeconomy related to trade, tariffs, and trade deficits and a trade war. These are things I want you to be aware of and be prepared for. I hope you found this video useful. If you would like additional videos on this topic as I make them, please subscribe to my channel, like this video, and if you have any questions or comments, please put them below. I'd be happy to answer them. In addition, if you're looking for resources, assistance services, free additional content on how to scale your SaaS business, regardless of the macroeconomy, go visit my website at saasceo.com, and there's a whole library of resources that I think you'll find very useful.